Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Welcome to the stock play of the day. Today's stock is NVIDIA, symbol NVD. We'll discuss, should we pass or should we play? Hello, everyone. My name is Brian Overby. I'm the senior options analyst at Ally Invest.
And I'm Lindsay Bell, Chief Investment Strategist at Ally Invest.
Well, Lindsay, a lot of news over the weekend, and we're seeing the indexes higher today. What's going on in the markets?
Yeah, the indexes are higher today. We're breaking a 4-week, or last week we broke a 4-week losing streak, and it seems like we're going to continue that trend today. Friday obviously was a bit of a weaker day when the world found out that President Trump had contracted the COVID-19 virus. But good news has come out on that over the weekend. And we're going to hear from him and his doctors today to determine whether he'll be released from Walter Reed Hospital, where he spent the entire weekend. He's on a couple of treatments, and the market is feeling optimistic about his health at this time. Investors are going to, however, remain sensitive to any information about Trump's health in the weeks ahead, regardless of whether he's released today or not. But also pushing markets higher today is stimulus deal optimism, I would say. Pelosi, Speaker of the House, Nancy Pelosi, has said progress is being made. Trump putting pressure on Congress overall over the weekend, saying work together, get something done. And I think the jobs report on Friday really put the most pressure on Congress to get something done, because while 661,000 jobs were added in the month of September, we found out on Friday morning. That's a big number, but it's been decelerating over the last couple months. And even at that rate, it's still going to take about 17 months to gain back all of the jobs that were lost because of the pandemic. To be sure, we've gained back just over half of the jobs that were lost, but there's still a lot of work to do. And while the virus is still out there, there's no vaccine yet being distributed. Government's going to have to do a little bit of work to help these, especially small businesses and individuals, along, while the economy still remains only halfway to 60% open at this point in time. And then also, we got some news kind of counteracting that on COVID in general. In New York City, there are a couple different zip codes they're going to be shutting down schools and some businesses, I think in the Queens and Brooklyn area, excuse me. So that was kind of a negative over the weekend. Paris is announcing new restrictions as cases rise there. So there's a lot of data, but the market is clinching to the good news today. And you see, we've got a chart here that, Brian, you've pulled up. We saw a big pullback in the S&P 500 after that September 2nd high. We've been moving higher for the last several sessions here. What we like to see, we've been showing these moving averages for a couple weeks now. And the red line is the 50-day moving average. Today, we moved nicely and easily above that. We're staying above it right now. We'd like to close the day above that, but we've been tracking around that 50-day moving average for the last several days. Brian and I, we've been talking about this for a while. This really is has been a technically driven market. So that's why neither of us are market professionals or technical professionals around. We are market professionals, but we're not technicians. But when we notice trends around some of these moving averages, we definitely take notice. So we're seeing that here. We're going to see if we can stay above the 50-day. We're still well above the 200-day moving average, which is that yellow line a little bit further down there. So there is the fear by some of the bears out there that we might come back and test that level, especially as the election approaches and creates more volatility, which gets me, Brian, to the point you and I always like to look at the VIX. we are talking about options here, it has it's remained stubbornly elevated. I think I would say today it's moving higher as the indices move higher, which is kind of unusual. Uh, what's your take on this as we go into the election? There is this thought that there's going to be more volatility, but what happens after?
Right. Okay. So, yeah, to highlight, I think the oddest point of the market today is the fact that we have the SPX up 45, as you see here from my little watch list that I keep on the VIX. And we also see the VIX index up $1. Now, that's on top of the fact that the VIX just can't seem to go below 25. Not only are we seeing the VIX index staying at those elevated levels since the announcement of the pandemic, we're seeing on even up days, the VIX index actually increasing. Now, this is counterintuitive because usually the VIX index can be referred to as the fear index. And that usually means that when markets are going up, the VIX is going down, and vice versa. When markets are going down, the VIX is going up. Now, that just means there's a little nervousness in the marketplace. When the VIX is at elevated rates, a lot of people attribute that to people buying protection, buying puts in the SPX to protect a portfolio, for example. Since there's more buyers than sellers on those puts, we will a lot of times find out that that will drive the volatilities up and hence the VIX index. Now, something to note to go along with that is, and you, Lindsay mentioned it a little bit here, if we look at October and specifically November, which we know we got the big election, we see the VIX even higher. We see the VIX at 31% in October based off of the futures contract that tracks the VIX index. And in November, we're all the way up to 32.30 on the VIX index. Now, they're down a little bit going further out in time, which that would make sense to me considering the market is up quite a bit. But the fact that they're elevated, even though the spot or the actual VIX index is trading right around 28%, that's a little bit unusual. Usually when the VIX is at an elevated rate, way up above 25% implied volatility, it's a mean reverting index. So you usually see the futures contracts trade closer to the mean as you go out further in time. So what does this say to me? It means that there's nervousness around this election, which I think is fairly straightforward. I guess most people out there can probably agree with me that there's a little bit of nervousness, but not only might we think that, the actual indexes are showing it. So we're looking for more volatility as opposed to less as we move forward into the year's end. All right. So with that said, let's talk about NVIDIA. I'll pass it back to you, Lindsay. Here's a chart. I have it up.
All right. NVIDIA is our stock play of the day today. And we are taking a look at this stock. We haven't talked about semiconductor stock in a while, so we wanted to take a look. We're seeing some recent momentum, and we thought it would be a good one to dig into. Now, before I get too far into it, I just want to remind our viewers that we do take questions at the end of this show. So there's a chat box on the right-hand side of the YouTube video there, and that's where you can type in as many questions as you like. We'll try to get to the majority of them at the end of the show. So be sure to type away right there. But back to NVIDIA, the stock, we're looking at the chart here. Brian's got a nice view of it up for us. And what we are seeing is that, the stock initially acted a lot like the tech sector after making a new all-time high at the beginning of September. You see that there kind of like in the middle of the chart in the 580 range, something like that. Dropping sharply, I think, as the market and the market participants realized that stimulus had stalled and there was, we weren't going to get it anytime soon. So this stock, just like the tech sector in general and the FANGs more specifically, fell kind of off of a cliff. But it's been able to bounce, and it's actually gained momentum, more momentum over the last couple weeks than the tech sector has in general. It'd be cool if we could show a layering those two two together that they like the XLK.
I can jump over and show a couple of charts on the FANG, but we do see a big green candle here. So like if we
Yeah.
go back, and I do have a FANG watch list that I keep too, and you just kind of see, if you look at the Apple chart here to start, and I'm just going to pull it up real quick, you see a very similar chart, but we just don't have the breakout that we are seeing in NVIDIA. NVIDIA's actually came down, tested a support line, and kind of bounced off of it a little bit. We see very similar charts across the board too. Like if you look at Facebook, that looks basically the same as Apple. Let's even look at Microsoft, which is one of the FANGs in theory, right? Same type of chart there. And then also Google even has kind of the same type of action that's going on. But the biggest thing when we look at NVIDIA is we've actually seen that breakout. All of them are kind of forming these inverse head and shoulder patterns, kind of deciding which way that they really want to go. NVIDIA is one of the stocks that has broke out, and that we obviously have a real big green candle. As we were talking about it early this morning on the open, looking at that stock, the stock has made a real strong run today. So let's get back to the fundamentals. Sorry.
Yeah.
There,
No,
Lindsay.
it's running today, Brian, because they're hosting an analyst day. So they announced a bunch of different things this morning. So the stock is up. I think about last I checked was up about 4%. So it's having a great day here, but it has broken out. I'm going to get more into this in a second. Since announcing on September 18th plans to acquire ARM Holdings from SoftBank. So we've seen the stock move about 11.5% higher, including this morning's move from that September 18th announcement. But this morning, like I said, they're having an analyst day. They're announcing a lot of new things. The market obviously reacting very positive. A lot of the news is about expanding their different AI research capabilities. They're working with different healthcare organizations like GlaxoSmithKline. They're going to use AI in conjunction with researchers at GlaxoSmithKline to be able to research new drugs and different types of vaccines. And this is a big deal. I think it just kind of goes to show how technology is being infused in the healthcare industry. And not only that, but also for the healthcare industry in general. Brian, you and I have done a couple different trades on that. How, the pandemic has really changed things, not only for the tech space, but also for the healthcare space, where they are being pressured to really increase the speed at which they do research and find new drugs. Also, in the amount of time it takes them to put those drugs to test. So but getting back to NVIDIA specifically, so they announced a bunch of AI initiatives. They've got a couple new products coming out that's going to be supporting the work from home trend that we continue to be stuck in place on. So they're doing different things to support video streaming, real-time collaboration amongst designers. And they also announced this new Nano 2G developer kit that was unveiled today. And it's really helping educate younger individuals and teaching them how to develop AI, develop and learn AI. So they're doing stuff on the educational front too. But again, the big game changer, I think, for most investors at this point in time is really this announcement of the ARM holding. They're going to pay $40 billion in cash and stock for this company that went private. SoftBank took them private in 2016 for about $31 billion. These guys, NVIDIA, paying $40 billion for the company. They're a chip designer. Different analysts are really seeing this, like I said, as a game changer for the company as they move forward. Remember, NVIDIA actually is the largest chip maker by market value right now, even though Intel, the older stalwart in the chip making business, has about 72 billion in sales at the end of last year, and NVIDIA had 11 billion. NVIDIA is growing very quickly. Intel's had a couple of hiccups within their business and growth. So they've had haven't been able to perform as well as NVIDIA has this year. So NVIDIA has surpassed them. But it seems like, especially in the near term, with this acquisition, the momentum is is in the sales of Nvidia stock, especially since it had that nice pullback off of the September 2nd highs. The only thing, one thing I would say is Micron did report earnings last week, and they're a chip designer. They're not a manufacturer, and actually Nvidia uses some of their designs. And they had a pretty good report. They beat on earnings, but sales were a little bit weaker than expected, and there's concern that margins are going to be compressed going forward. Part of that is the expense related to the product they're providing for Nvidia. But overall, the tone of that call was management was pretty positive about the outlook for the semiconductor space. So that certainly bodes well for a company like Nvidia. Again, they are a customer. So there's a lot going on with this stock. I mean, I know it's soared. It's like up 200% in the last year. It can be nerve-wracking looking at stocks like this, but with an environment that is changing as quickly as it is, company that is executing on its business strategy and taking big steps and initiatives to move forward like this, it's worth a look at least to see what's happening with the stock. And Brian, I know you've been looking at it, and you've been looking at it from an options perspective, and you think there might be a way that we could play this. What are you thinking?
All right. Well, we're going to look at a long call spread. And I'll be blunt. We were looking at this trade earlier this morning. Now, once again, it's not meant to be a recommendation here. We're just doing a paper trade. But with that said, we were looking at it this morning, and we were going to be buying one option contract that was a little bit in the money, selling an option contract that was a little bit out of the money. Now, why are we looking at a long call spread as opposed to an option outright? There are two factors here. The fact that Nvidia is over $500, it's a fairly expensive stock. That adds premium to our option contracts. And then you just throw in the sheer volatility of the marketplace and this underlying stock, and you have fairly expensive options. So in order to reduce our risk a little bit from buying an option outright, we're going to buy a call option a little bit in the money, sell a call option a little bit out of the money. Now, to start this morning, I was thinking we were going to do a 10-point wide spread, which means the difference between strike A and strike B here in the Ally Invest options playbook would be about 10 points wide. Now we're going to make that a little bit smaller. Why? Well, the stock's already ran up over $20. Before we got on the call, it was already up $21 at that point in time. So we've had a lot of the move, but the momentum is still there. It definitely bounced a little bit off of that support, that support line that we had drawn on the chart. And now I don't quite know where the next stopping point would be. So we're going to make it a little bit more conservative paper trade this week, based off of 100% a momentum play now, especially with the big up move in this underlying stock. So let's run over to the Ally Invest option chains. And we see, right now it's up 2089, 4% almost exactly. So it's even been up since we started the call. Right now, the earnings date is out until November, so we're not going to really worry about this. This is going to be, like I said, a momentum play, so we're only going to go out about 10 days in time. We're going to do that long call spread or a bold call spread. The expiration dates, we have many to choose from. The October 16th expiration is the normal monthly expiration. It's the third Friday of the month. I prefer to trade in those expirations just because usually have more liquidity, usually have a little bit better markets. So we're going to be doing that expiration 11 days out. It's an 11-day trade, obviously a very speculative trade, but we're only doing it on paper here. The underlying stock is at 543.69. So here's, as I mentioned, we're going to go a little bit in the money. We're going to buy the 540, and now we're going to sell the 545. I was thinking about going the 550, but with the big move out, I don't know if I want to risk too much capital. And by keeping the spread 5 points wide, we lower the overall cost of the long call spread. And on top of it, that means we lower the overall risk of the trade. So going out 11 days, October 16th, inside the Ally Invest option chains, we got the calls on the left-hand side. We're going to go a little bit in the money, buy that 540 strike, go a little bit out of the money, sell the 545 strike. We're hoping that that underlying stock finishes above 545 within the next 11 days to expiration. And it's truly a 50-50 bet then. By managing the strikes that we're buying, we're actually managing the time premium. If we go a little bit in the money and we sell a little bit out of the money and keep about equidistant, usually that means that you're buying as much time premium as you're selling. And then it makes it all about the stock price because you don't really have to manage that time premium erosion of buying a long call or swings in implied volatility. So by doing this trade and you're doing a 5-point wide trade, in order to make it a 50-50 bet, you need to buy a little bit in the money, sell a little bit out of the money. So since it's 5 points wide, that's the maximum the spread could trade for. That's the maximum you could make on it. If we look at the Ally Invest strategy workbench, we see that the midpoint is trading for $2.53. Let's call it 250, make the math simple. And we'll make this the official paper trade for the week. So I'm going to put it over here in the right rail. This is the Ally Invest order ticket. And we'll see that we're buying to open, and that's important. We're opening this trade. One contract of the October 16th expiration, 540 strike. Then we're going to go a little bit out of the money, and we're going to sell the 545 strike. We'll put the midpoint at a net debit of 250 to keep the math simple. That means for every 1-by-1 spread, the net debit would be $2.50 or $250 plus commission. And on a long call spread, that's your maximum risk. That's what you're risking for every 1-by-1 spread that you do. Our maximum upside would be $5 minus the $2.50 paid for it. Don't forget about commissions there either. And that means that we have $2.50 worth of upside. Now, if I run to the P&L calculator here real quick, let's bring up the profit and loss graph inside the platform. We see that here's where the underlying stock is at. We're a little bit actually north of center, right? Which is a benefit to us because we want the stock to get up to 545. We're not at 542.50, which would be right about here. So we're already leaning a little bit to the upside, but we're still only paying $2.50 for this underlying or for this spread. So benefit to us, right? If we're looking at a 50-50 bet, trying to risk as much as we can make. On the downside here, this is a very flat line, if you see here. And that means that if the stock runs up right away, there's a lot of premium in those option contracts. And I've already highlighted that, but let's run back up here. You see that we're dealing with $17 and $18 option contracts. So buying the 540 call outright, you're risking $19 or $1,900. This is where we're selling this other call. We're greatly reducing that risk, okay? But the downside is this line to start with, the colored line, shows you that if the stock does make that run up right away, there's not a lot of benefit to us until we get a little bit of time decay. And by a little bit, we got 10 days remaining, so it doesn't take that long to get there. Apologize for that. Here we go. So let's go all the way down to 1 day remaining to expiration here. And if we graph that, we'll go all the way down to 0 days. And now as we graph this underlying, you see as expiration approaches, we get a large rate of time decay. And eventually it's going to look like the profit and loss graph here on the dotted line on our P&L graph overall. All right, so very simple, straightforward trade. It's all based off of the momentum, the bounce off of the support, bouncing on up. We got a big move in the underlying stock. On the open, this would have been a little bit more interesting trade. But with that said, we always tape the stock play of the day at noon. So we don't get to pick our time, but we do get to pick our stock. So let's address some of the questions that are out there. I'm sure we got a few. Lindsay, what's the first question we might have?
Yeah, we got a couple. And just a reminder, guys, we're here to take questions. So feel free to type away and we will get to them. Scotty B, we'll take your question first. Can you talk a little bit about the difference between this trade and a caller? Why one versus the other?
Okay, now a caller, well, it's a great question, but the profit and loss graphs, if we actually run to, and I'll ask our producer to actually put this up. If we run to the options playbook, the profit and loss graph is very similar between a long call spread and a collar. Here is the long call spread inside here, and let me pull up a collar inside the options playbook. You'll see that they're very similar. Now, the difference is the capital outlay. If you're doing a collar, you're actually buying the stock and then selling a call and buying a protected put. So when you're doing that trade, you're capping your upside and limiting your downside, which guess what? When you do a long call spread, You're doing the same thing. So synthetically, they're the same trade. But the difference is with a collar, you own the stock. That means you're buying 100 shares of NVIDIA, which isn't isn't a low price stock. So that takes a chunk of change to do the collar overall. So this is an alternative to doing that collar where you have the same type of profit and loss. So a great question overall, but I would lean on a higher price stock to just doing the long call spread just because of the sheer cost to buy 100 shares of NVIDIA at a 500 and I actually even $544 price change. Now it's actually up to 22 at this point in time, so over 4% right now.
Yeah, that stock keeps moving higher today. So Robert Hansen is asking Brian, what would the profit target be for an exit?
Well, okay, so we've managed the risk here. We're paying 250 to make 250. So that right there, just to let it run, is okay. Now, some people might take the approach, and I just want you to be consistent with it, is that if I'm going to pay 250 and I want to make 250, if I'm down $1.25, if I'm down half of what I paid for it, I'm going to get out. But on the upside, I'm going to let the winners run. Now, with that said, it's very hard to get the maximum out of the spread, especially on an expensive, volatile stock like NVIDIA. So on the upside, if this thing is trading for about 450, 475, I would think about taking it off, because getting that last, let's call 25 cents worth of profit out of it, if your forecast is correct, is kind of hard to do. So now on the downside, you can decide for yourself. Do you want to manage the risk and say, well, if I'm down half of my investment, I'm going to get out? And I think that has a lot to do with the number of contracts that you're doing. If you're doing a 10 lot or a 15 lot and you want to manage your risk that way, where you have a little bit more capital in on it, that makes a little bit more sense. If I'm just doing a one lot here and I've already managed my risk by doing the spread, we've obviously greatly reduced the cost as opposed to buying a call option outright. Well, then I might just let this trade ride. So it's all about the amount of capital that you're applying to the trade to decide how I'm going to manage the risk on the trade. So with that said, though, once again, this is meant to be a paper trade. So I always want to emphasize that, because we aren't just trying to learn here on the stock play of the day.
Right, we're just learning here. We've got we have two more questions I want to get to, Brian, in like 2.5 minutes. Okay. So Julio Sayre says, how do you choose an option strategy? I think you kind of talked about it there. Where can you find the implied volatility, and how can you make it work for your strategy? A lot there, but try to answer in 1 minute.
What was the last one, Lindsay?
And how can you make it work for your strategy? Implied volatility.
Implied volatility. Okay. So how do you choose? Well, that's kind of what the stock play of the day is all about. We always look at how the strategy fits the underlying stock. So there's a lot more to go around it. Part of the reason why I can just talk about why we chose this strategy today. And it has everything to do with the fact that, and I'm highlighting on my screen, that NVIDIA is a $544 stock. If you think of options, they're priced like insurance contracts overall. That's where options actually were derived from. There's a lot of similarities between the insurance market and the options world, in that if you're buying car insurance on a Bentley, that's the word I was looking for, as opposed to maybe a Chevy Cavalier, you're going to pay a lot more for that Bentley contract, right? Why? Because the underlying asset is so much more expensive. So that concept applies in the options world. So if I'm trading it on an expensive underlying, just price-wise, I might want to think about doing spreads, long call spreads, short put spreads, short call spreads, etc. Something where I'm trying to reduce the overall cost of the trade. And then on top of it, where do you find the implied volatility? Well, inside the option chains here, we actually have a column for it. So here's our strategy that we're looking at. We just got the check boxes on the left-hand side. But right next to that column is the IV column, or the implied volatility column. So you can find it a lot of times in a charting platform. It'll show you the actual implied volatility for the underlying stock for a certain period. But on the option chains, it's usually in one of the column headings overall.
All right, we're going to squeeze one last quick question in here from Wayne. I hear the term backwardation used. Um, can you explain it and how, explain what it is and how to check it using the VIX?
Okay, well, it's all about, and I'm going to jump back to my screen again. It's all about the futures contract. So that question is really relative to the VIX index. If we go out further in time, do the futures say that the volatility index is going to go down? Or does it say that the volatility index, the spot index, is going to go up? So it's 100% a futures term backwardation overall. And that's implying that the VIX would be a mean reverting index and that it would actually, as we went out further in time, the volatilities would get less and less, which would be the concept in general. That's the norm that you would see with the VIX trading well above 25% implied volatility. But that's why you're hearing these terms nowadays, because if you're looking at the VIX at the spot index, first of all, the fact that it's still up one point with the SPX up 47%. But as we go out further in time, and I'm highlighting the VIX, which is considered the spot versus the futures, we see the November contract trading around 32%. So expecting more volatility going into the election, which if you believe that the VIX is the fear index, that's saying that's incentivizing more fear as we get to that November election. That wasn't a short one. I'm sorry, Lindsay.
I know it's backwardation's not an easy one to do.
Yeah. You asked me to be quick, and then you give me a term like backwardation.
I like to challenge you, Brian. No, that was a great answer, though. And that's all we have time for today. So we're going to have to end the show on that note. But before we do that, just a reminder that Brian's going to review this trade on Friday at noon. So you should check into the channel right here to learn about the strategy as things develop over the next couple days.
All right. And I have to remind you also, you want to click subscribe and ring the bell, and then you'll get all the alerts for the next stock play of the day. See you on Monday. Well, see you on Friday first, and then see you on Monday. Thanks for coming, everyone.